So welcome everyone, or welcome back everyone, whichever might be the case, to this panel discussion in the asset management track. First of all, I was remiss in moderating the student session to thank the Salem Center at UT Austin's McCombs School of Business and Scott Boggess and Megan as well for setting this up, sponsoring this, and making this all possible for you guys, the PhD students. That's who it's for. It's a heck of a nice positive externality that the Salem Center and McCombs is providing to PhD students worldwide. And so I thank them and congratulate them for putting together a wonderful conference. Hopefully next year we can hold this in person and all enjoy Austin and seeing the McCombs School. Let's just keep our fingers crossed here. So this session is going to go pretty quickly. I have three distinguished speakers, and we have we have up to three topics, depending on how fast things go. But these speakers have a lot to say, and they know a lot about these particular topics. So I think it's going to be a tight fit for time. But that said, this is for you PhD students. So I want to keep, returning to how can these panel members and myself help you to think about your research or your potential research now and in the future, and in terms of institutional details, in terms of what has been studied already, in terms of are there particular areas that you think that these panelists might think would be interesting and fruitful for further analysis? All that type of stuff I'm going to try to tease out of my panelists here. So that said, please be sure to, if you have a question, throw it into the chat or raise your hand in the participant window, and we'll be sure to get to you, because again, it's for you guys. It's not for us. We're holding this panel for you guys. All right. Okay. So the first topic is ETFs, and we chose this topic. I think we were sort of unanimous in that this was probably the number one topic we want to start talking about. And fortunately, our first student paper was on ETFs, so we got a little bit of a warm up on that with Viet Dung's paper. But just to remind, ETFs are the target of a large amount of academic research and also professional investor research in terms of their ability to track indexes, their potential impact on their underlying holdings, and just in general, why are ETFs seem to be taking over the world and forcing out open-end funds and other investment vehicles. So lots of research has been done on this. I think there's still a lot to go as we find out more and more and have upset events like March of 2020 happen. There are always, any upset in the market is a new potential for a finance PhD student to form a dissertation. This topic is not going away anytime soon with the growing presence of ETFs, which I understand just achieved the same level of AUM as open-end index funds, if I saw that correctly, in the United States. So I'm going to start with my first panelist, my friend Ananth Madhavan. I've known Ananth for many years, even decades. Ananth was a top-notch academic, and still I kind of consider him as a top-notch academic working at BlackRock, which is to some extent a very top-notch, not to some extent, it's a top-notch research firm. I've always characterized BlackRock that way. Ananth is managing director and global head of research for ETF and index investing at BlackRock. He's responsible for advancing thought leadership and innovation for iShares through research and analytics, which I presume means that he's studying the design of new iShares and how well existing iShares are working, which is a huge responsibility. He's been with BlackRock since 2003, and previously he was at ITG, which is an algorithmic trading firm. So and previous to that, he was a professor at the Wharton School and USC's Marshall School. So he's basically an expert on all sorts of things in asset pricing, including trading technologies, trading costs. If you haven't had a chance to look up Ananth's papers, they are classics, a few very classic papers with Don Keim, one of which I leaned on heavily in one of my papers, Keim and Madhavan in 1997, one of my favorites, Institutional Trading Costs, but there's many more beyond that. So let me stop there. And what I'd like to invite Ananth, I'd like invite you to do is to set the table and talk a little bit about the industry's view of ETFs. What's going on here from the industry point of view?
Great. Thank you very much for that overly generous introduction, Russ. Indeed, good friends with all of our panelists today, so it's a real pleasure to speak to all of you. In the context of just setting the stage, I'm based in San Francisco, which explains why I'm wearing 3 layers, including a wool sweater in the middle of August. Our team, the team is now 60 people in 5 locations around the world. We do a lot of research on ETFs and index funds. And just to set the stage, again, this couldn't be more timely. There's an article in today's Wall Street Journal, August 12th, by Michael Worsthorn, and it's titled "Global ETF Assets Hit $9 Trillion." So this just in the first 7 months of this year, ETF inflows have been a total of $700 billion. That's $100 billion a month flowing into global ETF assets around the world, which is an astonishing figure. To put that in context, Russ mentioned my work, in the 90s, and actually to date myself, I was a PhD student in the 80s, and have since spent more time outside of academia than in academia. But I still remember the first ETF launch in 1993, that is in the US. Actually, the Canadians were first, so any Canadians on the call, you actually were first with the first ever ETF traded on an exchange, on the Toronto Stock Exchange. But in the United States, the SPDR SPY was the first ETF launched in 1993. And at that time, the AUM in ETFs was tiny. Now it's past $9 trillion. So what's going on? What are the key themes that we see as the world's largest ETF manager? Well, there's several themes that I think are very relevant. And in the Wall Street Journal article today, they highlighted the growing flows into actively managed ETFs. And for my colleagues who are with the SEC or were with the SEC, I should just mention that the SEC's rule change was a big, recent rule change was a big driver of flows into actively managed ETFs. And again, that's a great topic for PhD students. Other things that we're seeing is the rise of thematic ETFs. So people wanting to play themes like clean energy, various themes, including religious themes with ETFs. All of these are sort of vehicles that are very popular for those kinds of thematic things. The third driver is the rise of ETF models. So many models are constructed using ETFs. And by models, I mean offerings by Betterment or Wealthfront or Schwab, Intelligent Advisors. These are automated so-called robo-advisors, basically a prepackaged asset allocation. And typically the modern versions of these use almost exclusively ETFs. The flows into those have been remarkable. And, we did an internal study, my team did an internal study. We reckon there were about 8,000 models using iShares. And that the total AUM in those models was in excess of $330 billion. So rapidly growing, double-digit growth, organic growth in models. And finally, the fourth thing that we are cognizant of is the rise of fixed income ETFs. So the early ETFs were almost exclusively equity ETFs, broad-based tracking indices. With the development of fixed income indexes, we saw the rise of ETFs against those indexes, starting with treasuries and investment grade, but now broadening out to other sub-asset classes of fixed income. Again, a fascinating area because the liquidity of the underlying bond markets is severely challenged, again, as most of our panelists are well aware. and yet you have these very liquid instruments trading typically with fractional bid-offer spreads. So it's an exciting area. I think it's going to continue to grow, and I think there's a lot of potential topics for interesting PhD dissertations. So let me stop there.
Thanks, Ananth, and I'm certainly going to come back to you on the fixed income ETFs and hold your feet to the fire on that one. But first, let me move to Sean Collins. Sean is Chief Economist at the Investment Company Institute. The Investment Company Institute, if you don't know, is a great source of data and statistics for many academics. I have benefited numerous times from their generosity and openness. They are the industry's research, you might call them a trade group, but they also do a ton of research at the ICI, collect all kinds of great data, and represent the industry in its discussions generally on Capitol Hill and elsewhere. Sean is chief economist, as I said, oversees the Institute's statistical collections and research on U.S. and global funds, financial markets, U.S. retirement markets. And he also, comes from a heavy economic research background way back when from the Fed and from the Reserve Bank of New Zealand, and has a PhD in economics from UC Santa Barbara. Sean, what's going on with ETFs? Is this just ETFs taking market share away from open-end index funds and punishing them, or is it something more going on here?
Yeah, I think it's probably a number of things, and Ananth alluded to some of those. So one thing is what you see in the data is that so a lot of the current growth in ETFs, inflows to ETFs, is in the equity space. And we do see outflows from equity mutual funds, and that's been both primarily on the actively managed side, but in recent months, it's also been on the index fund side. So it's probably some of both of those. That said, we see something different on the bond fund side. As Ananth mentioned, bond ETFs are growing very rapidly. Flows through June bond ETFs for this year, we've got about, I believe, about $250 billion in inflows, something like that. $300 billion over the last 18 months. So very strong inflows into bond ETFs. At the same time, on the mutual fund side, we're seeing extremely strong inflows into bond mutual funds. So for example, through the first 6 months of this year, $238 billion. And if that were to continue into the second half of the year, that would be a record inflow into bond mutual funds. So it's kind of a mixed bag. I think you're seeing on the equity fund side recognition that ETFs can provide exposure very, very inexpensively, tax efficient, and as Ananth mentioned, that there are a lot of, on the distribution side, a lot of registered investment advisors who use models or have offerings where they manage a portfolio on your behalf or with model portfolios, and they typically use ETFs because they're efficient and low cost. And so I think kind of all of those things together are probably factors, and just more broadly a growing recognition of who the product is out there, and that it is. I think it's just becoming more widely used in general.
Thanks, Sean, and certainly highlights that Ananth landed in the right place at the right time for this explosion. Good stuff. My third panelist, Alex Schiller, is the Assistant Director of the Office of Asset Management at DERA, Division of Economic and Risk Analysis at the Securities and Exchange Commission. DERA is also a good friend of academics in terms of cooperating with data and also with ideas and institutional knowledge. Alex is a new friend of mine. I didn't know him before forming this panel. I'm looking forward to his comments. He joined the commission about 5 years ago, PhD in financial economics from Carnegie Mellon. And he has a lot of experience in thinking about ETFs. And I know that Alex cannot talk about current deliberations at the SEC. But I'd like to invite you, Alex, to discuss a bit about what's going on internationally, the discussions about systemic risks of ETFs and things of along this flavor.
Sure, yeah. I'll start off with the obligatory disclaimer that everything I'm going to say are my views and not the views of the commission, commissioners, or other staff at the commission. So the SEC is a member of the Financial Stability Board and IOSCO, which are international bodies of securities regulators in the case of IOSCO, and mostly central banks in the case of the FSB. And both of those have worked on investor protection and financial stability issues related to exchange traded funds. And we actually had, I think this was about 2 years ago, the SEC hosted a workshop on those issues. And I think both Ananth and you, Russ, participated at that workshop. It turns out that the reports that were created as part of this are not public, but the commission has addressed ETFs and those issues in a number of contexts that I think is useful for me to walk through. And I think we all read the same papers, we all observe the same market events. So one of the things that we looked at, and this was in the context of the exchange traded fund rulemaking in 2016, I think, 2019, which provided a framework for essentially plain vanilla ETFs to come to market without first requiring kind of specific permission from the SEC. And one of the things we looked at was the functioning of the arbitrage mechanism, right? So how closely do the prices of ETFs on an exchange track the net asset value of these funds? We looked at that during normal times, and the staff of the Division of Trading and Market, together with some of our economists, have actually published very detailed reports of 2 flash crashes, one in 2010, the other one in 2015, where there was short periods of times where ETFs traded at prices that were at times fairly far removed from NAV. I think one interesting question here, and I think Ananth has done some work on this, is when, say, the underlying market is dried up temporarily or is even closed, maybe in the case of international markets, to what extent do ETFs provide price discovery? So I think that's one interesting question there. The other area we looked at, also in the context of that release, was the effect that ETFs have on the underlying assets they hold, on market quality in those assets. So those would be things like informational efficiency of stocks. How quickly do they incorporate systematic information? There's literature out there on that, literature on volatility, whether it's fundamental or non-fundamental, what it does to the correlation of stock returns, and how things differ between stocks and bonds. So those were some of the things we looked at there. In another context that came up, where ETFs came up, is the recent derivatives rulemaking adopting release. And that's a rulemaking that established a framework for funds' use of derivatives, and one kind of fund that uses derivatives extensively, levered or inverse levered funds. And those are predominantly, though not exclusively, exchange-traded funds. These exist as open-ended funds as well. And there, I think there's this two big picture kind of angles here. One is the property of the returns of these funds. So these funds over a single day they track a multiple of the return of an index. But if you hold these over longer holding periods, you get return patterns that are not as simple. And DIRA actually published a note on our website that investigates those analytically. So there was like an investor protection, investor understanding angle to that. The other angle is, because these funds keep their leverage ratios constant over every day typically, they have to rebalance their portfolios at the end of the day if the underlying market moved. And the question is, do these mechanical rebalancing demands, what do they do to the underlying markets? And there's some literature out there. One paper that finds some evidence of an impact, and there's actually one paper by a former colleague of mine, Stephen Lenke, at the commission. I think he's now at Penn State, who looks at how actually flows in these funds mitigate the size of the effect. So when a fund would, have to rebalance in a way where they have to increase exposure, typically that would tend to coincide with outflows. Right, so I'll pause there. I could say some things about non-transparent ETFs, but we can also save that for later, if you like, Russ.
Alex, I'd like to invite you to talk about Bitcoin and non-transparent ETFs. I think that'd go well right now.
Okay, sure. So I think, so with non-transparent ETFs, right? So ETFs traditionally have been vehicles for index funds. And the reason for that is because the arbitrage mechanism, at least in its simplest form, requires authorized participants to have transparency into what the fund holds. And non-transparent ETFs, the idea is that you could have an actively managed funds, right? And active funds, they don't want to disclose their full portfolio and full trading because that's the secret sauce. So the commission has approved, I think, at least one or two mechanisms for these funds, and these funds have started trading. And these mechanisms are ways for the sponsors to use intermediaries generally to try to obfuscate the exact composition of their portfolios just enough to kind of ameliorate the concerns of disclosing proprietary information, but at the same time to disclose enough or use intermediaries where arbitrage is possible. I remember when we first looked at these applications, one of the things we looked at was whether one could actually reverse engineer the portfolios, even though the information that was disclosed about the portfolios was obfuscated. And DIRA actually published a technical note on that. So I think that's one of the interesting aspects there. And I think in terms of the success of these products ultimately in the market, right? On the one hand, there's this mechanism to provide non-transparency, which presumably incurs some sort of cost. Also presumably, if market makers don't get the most precise information about the composition of the portfolios, maybe they would demand compensation for their arbitrage activities. On the other hand, ETFs have some innate advantages, such as tax advantages, and they might have low fees. So I think there's interesting questions there about the choices that an investor would face, or the trade-offs between investing in an active open-ended mutual fund versus an active ETF. On Bitcoin, just really high level, I think good questions to ask. What are desirable features of an underlying market that would allow an ETF to trade on that market? And I think a related question is, would the introduction of an ETF naturally draw liquidity to an underlying market or not? Or is there some sort of precondition that one should base on these markets?
That's a great lead in to circling back to Ananth. Ananth has an interesting paper on fixed income ETFs. Ananth, do you want to talk about that a bit and how you would address whether ETFs fit the fixed income market well and how they're working?
Sure, happy to. So we've actually got a number of papers on fixed income ETFs. It's an area of interest from an academic and regulatory viewpoint, as Alex touched upon, and Sean also touched upon. I think one of the questions that always comes up is this idea of liquidity mismatch, and obviously when the SEC is considering Bitcoin ETFs and the like, that's a foremost concern. And the term liquidity mismatch is a bit of a misnomer. It applies to a fund which is trading in a very liquid manner, where the underlying securities are perhaps very illiquid. People have repeatedly cited this idea that there's a problem with fixed income ETFs because the underlying bonds may trade once a week or once a month, and yet the ETF itself trades typically with a bid-offer spread for large and established ETFs with a bid-offer spread of a basis point or less, right? So how can this be? And the answer is actually pretty simple. If you go back to the basics of market microstructure, a broad indexed fund is obviously much easier for a market maker to hedge, so there's less inventory risk. And there's also no asymmetric information unless you've got a private line to the Fed. So you cannot anticipate interest rate movements and the like. So by contrast, an individual bond, if somebody wants to trade that bond in size, there is a severe asymmetric information risk. The seller of that bond, for example, may know about a downgrade, and the market maker has to protect themselves against risk by widening the bid-offer spread. So there's no contradiction there that the ETF is trading in a much more liquid manner than the underlying bonds themselves. So that's the first point. The second thing that comes up all the time is around the March 2020 behavior of ETFs, where we saw premiums and discounts of upwards of 5%. In very liquid ETFs, very well-established ETFs. And this drew a lot of attention from the press, talking about market discontinuities and the like. We did some research, and this is in the paper in the Journal of Index Investing with myself and a couple of co-authors. And what we showed in that paper was that really the premiums and discounts were not actionable. They reflected latency in NAV, net asset values. And at the time, this has since changed, but at the time, the net asset values for bond ETFs were computed at 3 p.m., even though the trading went on till 4 p.m. So in a period of extreme crisis, you could see that the NAVs may not reflect current market conditions and may have wide premiums and discounts. Those premiums and discounts often reflected the fact that some of the underlying bonds were not trading, and therefore the prices of those bonds were perhaps recorded long ago. And what we showed is that really when you looked at the primary market, there was not evidence of creations or redemptions, which suggests that these premiums and discounts were not actionable. And we produced some other statistical evidence about that in the form of just showing that the NAV returns were severely autocorrelated, which suggests they were playing catch up, whereas the price returns of the ETF were not, very much like a FAMA 1976 efficient market kind of things. The last thing I want to just touch upon in bond ETFs was, the idea that somehow the lack of redemption activity in these periods when there were premiums and discounts had something to do with the nature of the bonds that were being put in the redemption basket by asset managers such as BlackRock. And so we did take a careful look at our redemption baskets. And what we found was, and some commentators noted this, that the redemption baskets are typically a couple hundred securities, whereas the underlying bond indexes might have 1,200, 1,300 bonds in them. No problem there, because really what matters in terms of asset managers trying to protect the fund is that we match the factor characteristics of the bond portfolio. And we can do that pretty simply because unlike equities, bond portfolios are closely tracked by factors such as duration, convexity, credit spread, and industry and sectoral dummies. So we can actually produce a tight tracking error with a smaller subset of bonds than the underlying index. The quality of those bonds in the redemption baskets matched that of the underlying fund in terms of characteristics, liquidity characteristics such as bid-offer spreads and the like. So those are the papers that we produced to sort of just provide transparency and shine some light on the behavior of bond funds, particularly around the COVID crisis.
Thanks, Ananth. And I just wanted to give a little bit of value added, a little bit of alpha myself here to the PhD students. Where do you get data on ETFs? Well, there's a company called ETF Global that a lot of people use. I think they don't have a huge amount of history, but if you're looking for daily holdings of ETFs, I think they have that. I think more promising is Morningstar. You do have to contact Morningstar and work out a contract and FTP the data, buy the data and FTP it, because it's just too much data to download through Morningstar Direct or things like that. But there's certainly a lot of data that is coming online now on ETFs for research. Ananth, just a couple more quick questions, and then I want to move on. So can PhD students learn a lot about ETFs from the futures literature back in the 1980s, stock index futures? And then the second thing is, you know, and I'm sure this could take a lot of time. I just wanted some quick reactions to you about the role of authorized participants, since they seem to be sitting right in the middle of everything.
Yeah, okay. So let me start with the futures question. So obviously there's some parallels. So many institutional investors are using ETFs like futures contracts to gain and take off exposures very quickly. We've published a number of papers that show that actually, contrary to popular belief, it may be, depending on your holding period and funding status, it may be cheaper to actually trade ETFs to gain exposure, take off exposure versus a futures contract. It does depend on the roll costs and the holding period, but we've produced these analytics that help our institutional clients understand when to make that decision. So I think there are interesting PhD questions about lead lag effects. You know, clearly that parallels what we saw in the futures literature back in the 90s. But arbitrage, and that naturally gets to your second comment about authorized participants. So, you know, obviously, if there was a arbitrage opportunity, these authorized participants are there to create or destroy fund shares. That's what makes the ETF an open-ended fund structure, and it adjusts the supply of shares, you know, in keeping with the demand for those shares. So the authorized participants play a pretty key role in that. One of the things that comes up all the time is this question of step away risk. So what would happen if the authorized participants were to back away? Well, you know, the fund would trade like a closed-end fund temporarily. But the point to note is that even though there might be only one or two active authorized participants in a given fund at a given time, they're typically north of 30, 35 authorized participants who signed up and theoretically could step in at any point in time. And the ICI has done some great work on this, and I would highly recommend their paper on authorized participants for anybody who's interested in learning more about this, as Sean well knows. Keep in mind, I think a very important point is the authorized participants are not required to step in. They do so if it is profitable for them. So they will buy the cheaper asset. Let's say the ETF is trading at a premium. They will then buy the underlying stocks or bonds, sell short the ETF, deliver the bonds to the ETF issuer and get shares and then cover their short. That's how the process works. And they will do it if it is profitable for them to do it, net of the round trip transaction cost, market impact in particular, and sort of a minuscule creation or redemption fee that is charged to cover costs. It's typically very, very small. So, you know, even if the authorized participant themselves is, for whatever reason, balance sheet reasons or whatever, unwilling to do this transaction, they will typically rent out their pipes to others, such as, you know, hedge funds and others who see the arbitrage opportunity, may not have signed up a contractual deal with the asset manager, but want to do the transaction. And, you know, no authorized participant is ever going to say no to free money. So if they're just renting out their pipes, it costs them nothing. They're making money, even if they don't want to do the trade. quant hedge funds and the like will do the trade. And then lastly, you didn't ask this question, but it came up a little earlier about the impact of ETFs on the underlying securities. And Alex mentioned this as well. And, the SEC has done some great work on this. But I will say that there's some recent work. I see that Zhong Duan is on the call, and he's got a paper on muni bonds and the effect of information flows from the ETF to the underlying bond market when those bonds are quite illiquid. And so I'd say that some of the recent evidence is actually highlighting the informational flow from ETFs to the underlying markets, which is also, I think, a great subject for future research.
Yeah, I remember you reminded me of Joel Hasbrook, who we both think is a wonderful researcher at NYU Stern. His old paper on which type of security reflected information first. And I think his conclusion was E-mini futures. Or maybe it's, I don't know, ETFs had a strong role in that, and maybe they are now providing price discovery first. Thanks very much. Any particular researchers that you think, I think that something that's useful for PhD students is particular researchers who they might want to follow? Any suggestions from any of the three of you in terms of who are your go-to researchers in this field?
I would say Ananth.
Well, there we go. All right.
Can I put in a quick plug?
Yeah,
just
sure.
Underscoring what Ananth has said.
Sure.
For the PhD students, I think if you're going to work in this space, it is really important to understand the AP process. There's been a lot of discussion over the years about what APs might or might not do during a crisis, and we have some papers that Ananth referred to on our website that really get into the institutional details of how APs work. And if any of the students are interested, I can point you to those. But one thing that we did is looked at what happened in March 2020. And one of the concerns had been that up until that point, that during a crisis that APs might step away from market making because of capital concerns. And so one of the things we did is we went out and did a survey to see, what APs were actually doing during that point. And if anything, it's just the reverse. So what you tended to see is that there were typically a few more APs stepping into the market during March 2020 than there had been on a normal basis going into the crisis. So, and we've got a bit of a discussion about why that happened, but it's good background reading on for the institutional details.
Great, thanks, Sean. If you are able to post a link to that article, I'd be interested at the very least.
Sure.
It'd be interesting to see if you parse the APs who did step in by their size or anything to this regard, their characteristics. But fascinating stuff. So let me pivot. I want to pivot to our second topic, which is environmental, social, and governance disclosure, ESG disclosure, which is, has been for the last, I'd say, 5 to 7 years, a big research topic among academics. And it's pretty obvious, similar to ETFs, but maybe not quite as explosive, are ESG investments and the way that investors are pushing toward ESG related investments, whatever that means. And that brings a good question here for our panelists. But if you watched the very interesting panel discussion yesterday afternoon between John Cochran, Anil Kashyap, and James Stock, moderated by Laura Starks, it was a wonderful, and I think it's recorded and it'll be available later. It was a wonderful debate and discussion about ESG policies, what should be regulated, what shouldn't be regulated, the effect of ESG, and all of the difficulties of measuring ESG. So a lot of open questions for research in the ESG arena, including how do we measure this? Is there any hope? And for those of you who haven't been watching, new Chair Gensler of the SEC is really speaking out about the need for consistency in ESG disclosure and measurement, which I think is a major issue. So what I wanted to, maybe I'll mix it up here and I'll call on Alex first here. So what are the current kind of questions and issues that the SEC is currently focused on in terms of ESG investing, kind of building on Chair Gensler's comments?
Right. So there's kind of two sets of comments. One is sustainability for funds. And I think the overarching theme, the way the chairman has talked about it, is truth and advertising, both in terms of fund disclosure and in fund names, right? So funds might have different approaches to ESG. You might exclude a certain industry like fossil fuels. You might have assertions about emissions or water sustainability of the underlying assets in your portfolio. Or you might have claims about how your portfolio is positioned with respect to, say, a net zero economy. So his focus really is on disclosure that would give investors the ability to understand what's under the hood, both in terms of the criteria that the fund applies as well as the underlying data. And the other piece is names. And here the focus is basically that for ESG funds, that if a fund makes a claim about ESG strategy in the name, that kind of be reflective of the actual strategy the fund follows. He also mentioned that this type of disclosure would obviously be considered in concert with efforts that the Commission is undertaking in terms of public company disclosure of ESG related risks, right? So if you think about a fund trying to roll out ESG metrics with respect to the portfolio companies it holds, that's really where it's useful to kind of have those companies provide those metrics. The second topic is diversity and inclusion at asset management firms themselves. And I think this is partially something that also came out of the Asset Management Advisory Committee, which is a group of industry experts and academics that make suggestions to the Commission on policy. And the subcommittee noted that women and people of color remained dramatically underrepresented at the board and senior management levels within the asset management industry. And the chairman indicated that in a first step in improving diversity and inclusion here would be transparency.
Sean Collins, yesterday, John Cochran, I think, basically alluded to the idea that carbon emission is almost unmeasurable. So, why even try? And I think Anil Kashyap and James Stock fought back against that. And certainly Chair Gensler doesn't think that it's a hopeless cause. What just from your point of view, I don't want you to solve that. I would like you to solve that, but I'm not going to call on you to solve that. But what do managed funds want from their stock holdings, from issuers?
Sure. So, I mean, I think kind of back to what Alex is saying, I think funds have three largely separate objectives that they want to meet in getting information from issuers about climate and ESG more generally. One is for funds at large, irrespective of whether you're an ESG fund or not, they're investment concerns. So how is the climate or climate-related issues likely to reflect the risks and rewards of particular companies going forward? So you might be an oil company. If the price of oil falls going forward, that'll have implications for the value of the company. If you're, you own a bunch of buildings in Miami Beach and sea level rise is an issue, that could have pretty significant implications for the value of that company's holdings. So in investment concerns in general, funds are looking for information to help them make wise investment decisions in light of the fact that climate-related changes may have an impact on valuations. So that's one thing. Second thing is there's definitely demand for investors for ESG related information, and in particular, kind of as Alex was alluding to, if you want to have an ESG fund, somehow it makes sense to say, okay, well, how are we measuring what we're doing in terms of ESG in our fund that's different than just a plain vanilla fund, let's say. So information to help ESG funds do what they want to do and show that they're doing what they say they want to do. And then the third is there's obviously regulatory demands that funds may have to face on disclosure for funds in general. Could be funds that are ESG specific. So as Alex said, Chair Gensler is looking for something like, as he sort of puts it, a nutrition label for ESG funds. And so if that's a regulatory demand, fine. How do you create that? Well, one thing you've got to do is you got to have some information on climate related disclosures from corporations. So those are the objectives. I think what funds are looking for to meet those objectives is information about climate related issues, and also most of this tends to be about climate relations, but social issues are important as well. So Alex mentioned that. So employment, diversity, and inclusion. But I think what funds are looking for from issuers are data that's consistent, comparable, and reliable about any range of climate-related issues. They could be carbon footprint. They could be things like what's your usage of water in a particular issuer. There could be things like what does your supply chain look like in terms of creating a carbon footprint? So maybe you yourself are not pulling oil out of the ground, but maybe you're using plastic products to distribute your product. And so what are the implications for that on climate related matters? And in all of this, as I said, consistent, comparable, and reliable data. And so I think what you're talking about, Russ, relative to the discussion yesterday was what's the reliability of the data? And I think there are mixed views on that. There are these measures that are the students may have heard about, scope 1, scope 2, and scope 3. Those probably came up in the discussion yesterday. And I think, depending on whether you're talking about scope 1, 2, or 3, there are questions about the reliability of the data. Probably there's general belief that scope 3 is much harder to measure. And probably there's general agreement that scope 1 and scope 2 are probably easier. But there's also questions about materiality. So maybe scope 1 and scope 2 are really important for a particular company, and they're not so important for another company. Depends on what the company is doing. So there are a lot of issues around that, reliability being one. I'll stop there, and I'm sure
that's great. Shauna, before I let you go though, one thing I wanted to point out to PhD students is Lubos Pastors, Rob Stambaugh, and Lucas Taylor have generated a few very interesting papers on ESG investing, one of which I'll talk about in a second when I come back to Ananth. But Sean, one thing I'm wondering is, in your discussions with management companies, are they starting to set up separate climate risk departments, or are they setting up separate models, or is this all being done kind of in a heuristic way by portfolio managers, or what do you think's happening?
I think it's all of the above, probably. I mean, certainly corporations are, in general, are putting out a lot more information than in the past about ESG related issues. I think one of the challenges is that they don't put them out necessarily in a consistent format across issuers, and there can be good reasons for that. For example, an oil company might want to put out disclosures in a sustainability report that focus on oil in the ground pipelines, things like that. Whereas somebody that's a tech company, let's say an Amazon or a Twitter, they have a completely different business model, and so they may choose to report climate metrics, if you will, in a rather different way. And so the challenge is there's a lot of information out there by corporations, and its problem is trying to collect that data. There's also the problem that there are still a lot of issuers that don't put out data. I think generally the larger corporations are. As you go down the size range of firms tends to be, smaller companies, maybe it's more expensive for them to do. And so there's a challenge there. There are also challenges in that, there are a lot of issuers like sovereigns, municipalities, bonds. It can be challenging to find carbon footprints for those kinds of entities as well. So does that answer?
Yeah. And I think you brought up some really good points for PhD students to think about in forming a dissertation topic or a future research paper. Is the uncertainty in this area of measurement means that a PhD student who's good at text analysis and can run a text analysis of a lot of corporations over a long period of time might be able to find out whether more disclosure is helpful to the stock price or hurts the stock price or makes the bid-ask spread wider. All kinds of really cool and interesting questions that I think a PhD student could tackle. Let me circle back now, return now full circle to Ananth. Ananth, that paper, one of the papers that Pastor Stenbaugh and Taylor have written recently, or not too distant past, basically said that if enough investors care about ESG, it could become a priced factor. This is a little bit of maybe a clumsy way to sashay into your research with Andrew Ng. And for those of you in the audience, Andrew Ng was a top academic at Columbia University, now at BlackRock, and he has this neat textbook called Factor Investing. Just again, a tribute to the finance department that BlackRock has within their umbrella. But Ananth, can you tell us a little bit about this paper about ESG investing with Andrew?
Sure. So the paper's been published in the Financial Analyst Journal. I think it came out this year. And essentially the question we're looking at is there ESG alpha? And if there is ESG alpha, where does it come from? So alpha, we look at the fund level performance relative to the stated benchmark or the prospectus benchmark. We look at basically all active equity mutual funds in the United States, roughly $4 trillion of assets under management in about 1,300 funds. We're doing it at the master class level because otherwise you're counting, a multiple share class level funds as different entities when they're not. And what we do is basically we try to do a modern performance attribution. So we first look at the performance and we try to break down the alpha into its components. And we try to isolate a factor-driven component versus a security selection component. Then we relate those to the holdings of the fund. So it's a holding-based attribution. And in particular, we're interested in this question of how much of the alpha was driven by factor-based ESG tilts versus idiosyncratic ESG alpha, pure alpha. And essentially, to cut a long story short, when we do the attribution based on quarterly holdings data, we find that funds that that have high ESG scores, bottoms-up ESG scores based on their holdings, tend to load on momentum. They tend to be anti-value. They tend to be closer to minimum volatility strategies. They tend to be larger companies that they're holding, and they tend to be higher quality companies measured by things like ROE and the like. All of those factors, including the anti-value bet, were rewarded factors in the last 5 years. So a substantial portion of the alpha of these funds, which is related to ESG, came from the factor tilts that came about from loading on these ESG characteristics. So for example, getting to the points that Sean made, larger companies do a better job of reporting all these ESG metrics. So if you tilt to larger companies, your ESG fund scores are going to go up, but those companies actually tended to do well. Same with tech companies and high momentum companies. That's not to say that there might not be in the future idiosyncratic alpha. And so that's the point of some recent research we're doing, looking at flows. And in particular, what we see is dramatic flows into ETFs that have ESG mentioned in them, sustainable investing. Those flows may in turn create some price pressures on the underlying stocks. And that's a subject for a lot of very interesting research that I think might lead to idiosyncratic ESG in the future. I should also mention that there's this proverbial question of chicken and egg. I mean, if for example, investors shy away from, let's just say, high environmental impact companies towards low carbon footprint companies, that might itself create price effects away from, which may result in an idiosyncratic ESG alpha. And then there's the risk mitigation element as well. So there's some evidence that better governed companies are less likely to have an Enron style accounting scandal. So you mitigate the tail risk. Of course, you need a lot of observations, a lot of data to make that point. But I think this is all research which is very, very relevant for investment managers.
Thank you. Very helpful. Jeffrey Pyle, who presented the paper, has a question. Jeffrey, do you want to unmute?
Yes. So I'm just wondering, it seems like the SEC is going to broaden the regulation on firms' ESG reporting. But based on my understanding, I think the mandate will be most likely to be put on public firms. But it seems like both private firms and public firms have impact on the environment. So I'm just wondering about whether like new mandate on ESG reporting will put too much pressure or burden on public firms.
So I obviously can't comment on what it is that we're contemplating, but I think so. Your point, though, I think, is that it's not publicly listed stocks only. It's also private firms. It can also be bonds. It can also be foreign issuers, and so I get your point there, and I think you're also making the point that whenever there's substitutes, right, here in terms of whether you're publicly traded or not, if you're imposing a cost on one set, right, you might get substitution effects. So those points are well taken.
Great, thank you, Jeffrey. Did that answer your question, or Sean or Ananth, either one of you want to talk about private versus public? Is this creating a disincentive to go public?
Well, I guess I would say a couple things. I mean, I think it's a fair question. I mean, it's certainly a question that other people have asked. That said, it would depend on what the SEC would do. I mean, would it be, would disclosures be only for publicly traded companies, or would they be private as well? That's an open question. And then, as I said before, I mean, there are a lot of public companies that are already producing a lot of information and are expected to continue to produce and probably expand what they're producing already. So, given that, companies are already doing this to some extent. So I guess it would depend on what the exact rule looked like. And I think that that's one of the key issues here is, there's a demand for consistency, but, if you have firms that are very diverse, creating consistency could be quite challenging, and that might be, fairly costly. So I think the devil's going to be in the details here.
Ananth, I'll give you the last word if you want it.
Sure. I think Sean is right. The devil is in the details, and it's an exciting space to look at, and lots of great questions on the ESG front.
Thank you. Well, we're at the end of our hour. I told you it would happen quickly, and it's over. So if nothing else, which I think is not very likely, the very least you can get out of this is these three organizations that these three gentlemen represent are great sources for research and potentially data. Alex Schiller from the Securities and Exchange Commission, Sean Collins from the Investment Company Institute, and Ananth Madhavan from BlackRock. Thank you, all three of you. You certainly have, I think, helped many PhD students out there, and I'm sure you'll continue to do so.
Great. Thank you.
Thank you.
Thank you to everyone.
Thank you.